Henderson joins us with his global market take. Chris, has the market already priced in tapering, and what reaction do you expect from treasuries and equities in the run-up to the next Fed event?
Certainly the front end of tapering has been priced in. This was well telegraphed by the Fed. We got an immediate adjustment in bond prices last summer and in emerging market spreads. Also currencies began to move, but now they've stabilized. If you take that in combination with the fact that the Fed has been fine-tuning its message, it's clear that they have been successful in sort of front-loading the market with the beginning of the taper.
What's your view then on the dollar?
The dollar appears at fair value versus major currencies. The dollar, if you look at its performance against a basket of euro and Japanese yen, the dollar's really not doing that much right now. More evidence that perhaps investors have become more comfortable with the level of interest rates and that level of interest rates in the U.S. is going to remain fairly stable.
So, Chris, what is your view on India? Has the weightage rating changed?
We're modestly overweight in India. We've kept a balanced portfolio of shares which are both externally driven, investments in pharmaceuticals and in software services, but also domestically have been sticking with high-quality banking companies and telecommunications. There could be some room to add cyclicals in the future, but we'd want to see more evidence that the Indian economy has bottomed and is starting to expand again.
What's your view then, Chris, or rather your reaction to the Indian market hitting record highs in response to the state election results? And is the political risk out of the way now for India, since the expectation is running high on who will win the general elections?
I think there is some momentum into the Indian election. That's up for Indians to decide, but the early returns in some of the early elections have been encouraging that a consensus is forming that will be important for investor sentiment, simply because a period of uncertainty will be over. There is the risk, however, that the benefits from a new political cycle in India could be priced in prematurely, and investors could still be left disappointed the day after the elections.
Talk about the recent current account deficit data, which was also encouraging for India. There has been opinion that one more rate hike and the RBI will then pause. How is it that you're reviewing the macros, especially in light with the data that came out yesterday? And has that risk also receded now of inflation?
Well, the situation in India has been much improved by some of the actions taken to ban the import of gold, and that's had, if anything, the largest impact on the trade deficit and current account deficit by extension. So there have been some measures taken which have made things more stable in the near term, and I think that does help. But there are other sources of weakness in the Indian economy and other sources of inflation which still might need addressing through an extended interest rate cycle. So we'll wait and see on that and see what the data suggests in coming months.
So, Chris, what is your view on rupee and especially other emerging market currencies?
I believe that the Indian rupee is still remains one of the fragile currencies in the emerging markets, simply because India has very limited capacity other than slowing down the economy, which is really what we've seen in the last year, to limit problems with its trade deficit and by extension its current account deficit. So yes, things have been patched up a bit in India in that regard, but there still remain some significant challenges, and that from time to time is going to continue to weigh on the currency.
So are India and other emerging markets still vulnerable to the risk of QE withdrawal?
Yes, emerging markets remain at risk from this simply because there are implications for foreign exchange levels and changes in people's long-term perception of interest rate differentials between these countries. So there are still some substantial risks. And some of the recent measures that the Indian central bank have taken, particularly around bringing in non-resident Indian deposits into the country, are also not without risks, because in that case, if the exchange rate were to suddenly weaken, there could be some knock-on effects from that program as well. So we remain quite cautious on the Indian currency, and hence our asset allocation to the country.
So has the trade or bias decisively shifted towards cyclicals versus defensives? Has your portfolio strategy also been biased towards commodities, capital good, etc. versus FMCG and pharma?
As I've stated, our portfolio is quite balanced. Although we are hopeful that the cyclical aspects of the Indian economy will improve, we still like the growth prospects for pharma and for IT. They're not purely defensive because there's an awful lot of growth there, and they didn't grow to be India's largest companies by not growing. So I think it's more important at this stage to talk about growth, perhaps, where we think there is more growth in IT and pharma than perhaps in food and beverage, for the time being. And if we saw further progress in the economy, if we saw GDP improving or government programs after the election which were conclusively positive for infrastructure, we would move more into those cyclical type sectors.
What is it, Chris, that you have bought or offloaded from India in the last 3 months?
We've made no changes to our Indian portfolio in the last 3 months. We're very happy with the performance of our IT stocks, and we have seen a good recovery in some of the more conservative banking stocks in which we've got representation there. So no need to change. We're not chasing any short-term trends, simply focusing on the companies that we think are the medium-term winners in India, and looking through the election towards what stocks have the best growth prospects for 2014.
Well, Chris, appreciate your time and thank you for joining us.